doesn't grow. I mean, whereas resi has grown consistently over the past 30 years. Jeez. Okay. So who wants to? I think given we're sort of negging commercial, I think we should give Steve the first reply. What do you say about that? And what numbers do you got?
You're wrong. I win.
Wrong, but why are we wrong though?
Right. So there's a couple reasons why this myth comes about. The first one is like things like high density office spaces. So people will say, oh, they don't grow the same as a house. Of course they don't. A house does not grow the same as a high density apartment, for instance, because one's got a land component, one doesn't. One's got an oversupply, one doesn't. So that's where some of the myth comes from. The other part of the myth comes from generally commercial cycles are offset to residential cycles. So when we have like 5 or 7 years of really good capital growth in the residential market and commercial sits there for 5 or 6 years not doing too much, the residential people will then say, look, commercial doesn't grow, see? But they're not looking over like the 30-year period. They're just looking in a short time frame. One of the reasons why commercial takes a little bit longer is you don't realize the value until the leases finish. So if you've got lots of leases on 3, 4, 5 years lease, you're not going back and refinancing that property or valuing that property. So you get that delay there. Funnily enough, in the last 5 years, we've had about the same capital growth anyway. So that's a complete myth. The other point I want to note is different commercials are going to grow at different rates. So with residential, very easy to compare apples and apples, a 3-bedroom house and a 4-bedroom house. You can't do that with commercial. 150 square meter warehouse is different to a 500 square meter warehouse, which is different to a 10,000 square meter warehouse. Same as a suburban retail strip is different to an office space. They're all going to grow different rates. So the ones with less land component and less supply and demand are going to have less capital growth. Of course they are. The same as how a residential property in a mining town might not have the same as a blue chip property. So the different types of commercials, you're going to have different growth rates. But the point I want to finish on is you actually do have to have the same capital growth as residential. And the reason for that is if you don't, you'd end up with a huge disparity in price. And there's not. They always have to remain par. You're not going to have $1 million house that sits there for 5 or 10 years and then goes to $2 million and the $500,000 warehouse that's right next door to that $1 million house stay there at $500,000, because all the people living in a $2 million house, they're going to look at this $500,000 warehouse and go, why am I buying a $2 million house that rents for $800 a week when I can get 3 times more rent by buying this commercial property? Then the commercial property cycle starts and they all shift their money into that. So that there always has to be a price comparable. Otherwise, over 30 years, you'll end up with $5 million houses and $1 million warehouses. And it's not the case. They have to remain.
We need some examples on that, though. Have you got, I mean...
I can show you. We can go through and go look at any commercial warehouse, for instance, because warehouses I like because they have a significant land component. And tell me if you can find one that 10 years ago is not doubled in price.
And actually, that's a quick, like, if somebody were to want to look at it, what's the best platform to actually look at that? Because I wouldn't even know where to start to look at commercial, kind of what it's sold for. Is it real commercial? Or?
No, core logic, same as residential. It's got all the historical data of every property that's got a title will be on there. Yep. So this basically goes through the past. You obviously got to try to compare apples and apples, like ones that are leased and not leased and things like that. But almost every property in a blue chip area I've looked at has doubled in the last 10 years.
This is a chart of capital growth over since 1980 all the way up to 2022. And this is when people get worried about capital growth and flow times and those type of things. No one is buying a property, and you're not buying a residential and you're not buying a commercial for a slow period of time. You're not buying it for the next 1 to 2 years. You're buying it for the long haul. So this says from 1980 to 1992, we had an 11% growth per annum. So from here's 8 years of actual zero growth for Canberra. But this chart really does indicate exactly, why, maybe you should consider diversifying. Like, look at what Steve's done. He's bought properties in multiple states in different locations. But I like what you put up here, Steve. So it's good. But one thing is, Steve, so you're telling me that commercial, let's just bring our little faces back. Commercial grew 22% in 2001. In the Sunshine Coast, it grew 33.7% over the past 12 months. Capital growth far exceeds that in commercial or residential.
But this one is an interesting one because I think there's a part that. So I'm trying to think who I should let go first here. I'll let's let Steve go with this one because I think he'll come up with some interesting points that Joe may floor Joe. So what are your thoughts on is much easier to borrow more and higher LVRs in resi than commercial?
All right, so I'm going to Eminem him here in 8 Mile and tell him basically what he knows already. So getting started, Joe's right. Residential, you can get away with 90% deposits. So if you've got the choice of going out and buying 3 residential properties on 90% loans versus 1 commercial on a 70%, and you're starting out your portfolio, that is a rock solid option because you're going to have 3 times the property portfolio. If you get the same capital growth, even though I won the first round theoretically, and you get the same capital growth, you will make 3 times much in capital growth from the resi portfolio. So that's Joe will win on that one. I agree 100%. And that is one of the biggest negatives with commercial is the bigger deposits. Where commercial really comes into play, though, is once you actually start growing a bigger portfolio, banks don't give you 90% loans anymore. Most of the time, they won't even give you 80% loans. You actually have to start reducing your LVR as your portfolio gets larger into the multi-millions. And that normally comes down to serviceability because they can't handle a loan. Like we know banks do their shading. They add their 1.5, 1.75% interest rates. They turn all your loans to principal plus interest. Then they do their shading of like 20% vacancy on the property. So as I showed you that residential one before, being negative 15 grand a year and then applying that criteria on top, they're just going to say, no, we're not lending to you anymore. Whereas a commercial property where I showed you, even with those higher interest rates, it still looks good in the bank's eyes. So you can keep progressing your portfolio there that way. As I've mentioned on some of the other lives, you've got things like lease stock loans where the banks will give you a loan based on the strength of the actual lease. So commercial enables you to keep growing your portfolio. I'm not going to say infinitely, but basically throughout your kind of life. And the best thing to do is actually get a balance. So if you want to keep kind of maximizing leveraging, use the high cash flow ones. Use that apartment block that Joe kind of showed you or commercial to keep your serviceability high enough that you can keep buying. But then bring it back to what your goals are. So assess your goals. What are you actually trying to achieve over what time frame and what your risk profile is? So like an example for that is if Joe was 63 years old and he came to me and said, oh, look, Steve, I want to retire in 2 years' time. Cool. What's the point of buying a 90% loan residential property that's neutral or negatively geared? That doesn't help him. Commercial's perfect for him because he's got a bit of capital saved or he's got some properties paid off already. Commercial's perfect. If Joe comes to me and he's 18 years old and he's just starting out and he's got $50,000, we're not talking commercial. Like that's not enough to get in with a 30% deposit. Go residential, build that wealth base, and then shift into commercial after that. So I'm pretty sure Joe is going to agree with me on this, which means he's going to win the first half of the argument. I'll win the second half, but we'll see what he says.
Well, before we even get to Joe, one thing you kept saying 70%. Like my understanding is that commercial, you can actually get you can now get sort of up to 80%, depending on the asset, of course, and the lease and all that sort of stuff.
Yeah, there are 2 or 3 lenders doing 80% and quite competitive rates as well. But I was trying to be devil's advocate against myself, just to really compare kind of apples and oranges.
Mate, none of this devil's advocate. You've got to if you want to win, you got to get some fierceness in.
Long term, like I've seen enough portfolios and large portfolios now that I'm yet to see anyone with a huge multi-million-dollar portfolio that's at an 80% LVR. Like even residential portfolios. As you get your bigger portfolio, you become more risk to the banks. You have to start reducing. And that's why you see all those young gurus with $5-10 million portfolios. None of them have a 90% LVR. They've all got 50 to 65-ish% LVRs. And you need that, especially in residential, just to keep going. Commercial, yeah, you've got some excuse, but there's not many investors that just own 10 commercials and no residentials because you have to dip your toe in somewhere at some point.
Well, where do you see commercial going over the next couple of years? Like I feel like there's been a big shift in lifestyle movements and that's affected the inner cities but where do you see the market in the commercial space going?
Yeah, so similar concept to residential. I actually see a lot of the lifestyle areas performing really well. So then flowing on from that, the commercial properties there will flow on very well. Like I was mentioning Sunshine Coast, there's some of the tightest vacancy rates in Australia, and it's a lifestyle location because people are moving there and they can't keep up with stock. I actually went to the commercial town hall meeting last year, and they're out of commercial stock up till 2030. So they've got through it all already. So there's this huge demands for there. The normal question I get on sales calls is what happens with interest rates rise? That'll slow down capital growth. At the moment, we're seeing kind of 10% per year. I think that'll come off for the next few years. However, as we also mentioned before, rents are kind of jumping up 10 to 30%. So that's going to kind of offset it there. My counter argument to most residential investors is if they say, oh, cool, commercial's based on the cap rate, therefore you're not going to have capital growth. What is their argument for residential? Because if we have higher interest rates and the yields drop even more, who's looking at a 2% net yielding residential property going, oh, that's a good buy, I'll jump on that? They're going to want to put their money somewhere. And as I showed you in my cash flow spreadsheet before, commercial's still very attractive, even at 5-6% interest rates. So that I think we're actually going to see a bigger shift of investors move there. So like if we're a small pool now, I think in 5 years' time, there's more resources out there as well. Like there's like
that's 100% right. Like it's becoming so much easier to do. It's becoming easier to do the due diligence and know the stuff that you need to know because of the data. It's hard. Don't get me wrong, but there is more stuff out there. So yeah, it definitely is going to get
5 years ago, there was only a couple books on the market and they were very specialized. They were like, oh, this is how to buy a retail. And I was like, how does this not exist? And then I spent the 2 years writing it. But now there's multiple podcasts you can listen to. There's like 3 different ones I know that are really good. You've got multiple books on the market, plenty of articles and buyers agents you can follow and things like that. So no, I think there'll be a shift to commercial.
Why is commercial a better cash flow? Like why?
One of the ones is just a bit of an unknown resource that people haven't tapped into. So it's just non-investor. If every resi investor shifted their attention to commercial, prices would grow dramatically and the rents would stay the same, and then you'd get less of a yield. So that's one reason. There's actually just less investors in the market. The other one is you need bigger deposits, which we'll talk about later on the next topic. So it's a lot harder to get into. And that's what you're alluding to before of why I had to build my residential property portfolio first to be able to just get the deposit to get into it. So that's also holding people back as well. And then the other one is this lack of knowledge. People just don't understand it. Like it's just kind of, they put it outside their realm. So you've got less people looking at, bigger deposit, more of an unknown. That's why you get the return.
So with this one, why not buy, develop, and sell? So I'm assuming, Matt or Matthew, that you haven't done a development before, or maybe you have. But the reason why is transaction costs and just taxes as well. Because not to say don't do it, and it's a topic that people. I'm going to do a live in a couple of weeks or whenever it is. And I'll talk about this is why one of the reasons why I would have loved to have kept the development, because yes, I think we made 100 or 150K on paper. So we did make that, and that was after GST being paid and all that. So, but then of course you've got to pay capital gains tax, and you have to then, if you're going to keep doing projects, you got to pay stamp duty. And I know that some things are doing, you can do a once-off fee. You can do a stamp duty as what should we call it, as an annual fee, which makes it a little bit cheaper. But I just think the reason why, yes, it may be in theory faster, but how much of that pie are you losing? Let's just say you've got, whereas buy and hold, you can potentially refinance, provided you've got borrowing capacity. So that's why I necessarily wouldn't.
I'd like to answer this. So you can buy, develop, and sell, and you can make lots of money. I've got friends that are developers, and they make truckloads of money doing that. But it's a job. It's you're no longer playing the capital growth game.
Employee.
Well, because you're not even that. The whole point why we're talking on this podcast was we're looking for capital growth, which is holding long term. Property then is no longer property. It's just a product. You're buying pens and selling pens at an inflated price and making money that way. So it's a job, and you can do very, very well at it. You can also burn yourself massively with it. There are so many risks with doing developments, especially at the moment. If you'd bought a site, I don't know, a year ago and build costs and budgeted the build costs, and now trying to do that with 30-40% extra build costs, good luck making your 20-30% profit margin work. Like you are having a tough time. So it's just a job. You can do it, and you can make a lot of money, but you lose out on that capital growth side of it.